So, welcome everyone to the Tuesday version of the software strategy and general market updates, and occasionally droning ons from Steve Vetterl. I am one of the chief market analysts of Auvoria Prime. We are broadcasting from our brand new OBS system, which I probably need to learn anyway because we're doing a bunch of podcasting in Florida. So, without further ado, today is the 11th of January. We are starting off with just a quick couple of charts today. I know the Federal Reserve is going to open up the calendar. I don't know if you guys took a look at this Saturday's show, but I talked a little bit about some of the meetings coming up with the Federal Reserve, and it's like, wow, that's actually a first. Forex Factory's actually down. That's the first time I've ever seen that. In any case, I'm going to do this instead. I'm going to open up Word for us. So these are the weekend notes. I guess if I make this larger, there we go. All right, so coming up this week, we have Powell's testifying. He's been testifying all morning, and the markets have been kind of moving around a little bit on it. But really the bottom line is everybody's looking for more than 7% inflation growth is to be so-called the quote trigger to potentially start with a more organized interest rate increasing environment, right? Tough to do during a pandemic. It is difficult to understand that over the course of, let's see if I can make the screen a little bit bigger for you guys. I'm not used to broadcasting on one screen with an actual background just taken over. I'm used to just jumping between sharing screens. So what I'll probably do is just minimize stuff, just keep showing you the charts and so forth. But important thing to understand is that I think there's going to be a sea change coming up over the next couple of quarters by central banks. No surprise. Been talking about this for months and months, but we're beginning to see some real signs of it, as with a lot of the CPI numbers that we've seen from all different countries, it's been increasing. And we've been talking about this with clients and a lot of our employees, and certainly all the tremendous amount of subscribers at Auvoria Prime. I just want to make sure that they understand as soon as this starts to catch more wind and liquidity starts drying up in the marketplace, it's become a lot more volatile as far as anything that is related to MT4 type trades taken on any index, right? So keep that in mind. And if you've never seen my notes are actually going to be transferring over each Saturday. I try and get them posted Saturday to a new Telegram channel we're going to have, maybe called something like a Market Watch Traders chat, which is being set up. So stay tuned for that. I think that's an exciting way to get sort of like more input in what I talk about. It'll be a place where you guys can post your questions on anything related to markets broadly, any kind of chart patterns for anything, whether it be currencies, indices, what have you, crypto, so forth. So let me move over to our fun charts. TradingView.com is where we go. It's a good thing. Also keep in mind, as I showed on, I do want to take a look at this live with you guys. Let's see if I can share this. I'm going to go over to finviz.com. Make the screen a little larger. Here we go. So I like to go into futures where you can see like the whole dashboard. Try to make this a little bit bigger. And then go into daily charts and actually go into charts again so you can actually see this view. Get down maybe. Yeah, I guess that's good enough. I like to see this as a complete correlation comparison of one market's movement to another, right? And I show this a lot because it will begin to gel, if you will, with you that, bond prices are dropping across the board. Now, granted, we're only looking at U.S. Treasuries at this point, but they are falling over in Europe as well for some developed markets. What does that mean? That means that it's becoming more volatile as not only money selling out of the credit markets, right? Yields are going up. So this has a typically inverse effect in possibly pushing currency markets all over the place. And this is a factor of the marketplace, at least in terms of the credit markets, the bond markets, beginning to get a whiff of a lack of liquidity or a drying up, if you will, by the central bank. So Jerome Powell and his 12 governors, they've been out in the marketplace actively for damn near 12 years, um, sprinkling cash down upon primary dealer accounts and the basically buying up assets. If they start selling assets, it is a retractionary, a hawkish, or a removal of, to a certain degree, liquidity from the markets. What does that mean? It means price typically goes down. So that's why we're seeing a sell-off in bonds. Obviously, the flip side of that is that we've seen a lot of strength in the dollar, where it just absolutely tore out of a very, very strong resistance, and now it's up, as you can see, zooming around this lower chart here. And it's been building a balance for quite a long period of time. Same thing as the opposite, obviously, in the euro sold off. We've got a really big, big resistance line here right at this one spot 14 area, so you want to be aware of that. But surprisingly enough, we've seen a lot of strength in cable, right? The British pound here in relation to, heck, this has been stronger than anything really in terms of major currencies of any of these pairs. It's very easy to view with this. So let's just take a quick look at, you can see the energy space. Obviously, you can take a look at global equity markets. So Dow Jones, remember I always say don't pay as much attention to this because it's just 30 stocks that are price weighted, not cap weighted. So it's an inefficient index. So pay attention to the S&P 500 or the DAX or the the 225 in Japan, or take any of the NASDAQ. These are more efficient benchmarks as far as indexes. And in addition to the Euro Stocks 50, also look at the 600, which is a representation essentially of both of these index then in the aggregate. But looking at these markets, we've had the biggest weakness in small caps, no surprise. We've had bigger weakness in tech, right? We've had more strength in broad markets and defensive stocks of very recent. So a lot of tech funds have gotten absolutely crushed, like the ARC series funds and a number of the select funds of Fidelity, and most of those that are just specific to holding tech and bio to a certain degree. So I, the problem is, I could talk in generalities about all these indexes, but in trying to help everybody understand kind of the direction we're headed to, I don't know that I can offer going forward a ton of insight on that, just in maybe just a interpretation, if you will, of what's gone on, right? So I think I probably need to take my prognostication hat off. Although I've been pretty darn accurate the last year, I've gotten a lot of DMs for different subscribers saying I've kept them out of hot water. So in terms of me just trying to help you understand the hieroglyphics that is on the market wall, that I can do. What I can't do is I have no way in any oscillator or charting position to, sort of look to see what a lack of liquidity is going to do to global asset prices, right? And that's really the bottom line. Is that's what everybody wants to know the answer to, is the effects of changes in the different markets. So that being said, let's jump into trading view. Take a look at, a lot of you trade the S&P 500. Had a big reversal yesterday off of another of this yellow 100-day moving line. Big jump. So this is also a big area of what's called an air pocket, or a missing notch, if you will, in the market profile chart. So we had a big jump on that. I posted some of this and some other good traders' comments that I've retweeted on Twitter. So if you haven't already, you could certainly follow me at FXESTrader on Twitter. Show you guys the handle because I get asked this question a lot. I try on Twitter to really just retweet stuff that's just relative to risk and just macro events in the marketplace. Here is the Twitter account. For those of you that have gotten a couple of questions, I'm not sure if I ever answered this, but I use LastPass in all my browsers, and so does all of our employees at First Down. I even install this in a lot of clients' browsers because it really is the Fort Knox of filling in information in terms of passwords to protect you. Much better than Google, in my opinion. All right, so this is the account. Feel free to follow. I know there was something I did want to bring up here that I had posted. Where did I see that? I must not retweeted that. Yeah, forget it. That's my handle if you want to follow me. Go back to the charts. I don't know what the hell it is. So looking at currencies, let's get into the meat of the funness. Right. Daily chart dollar. Each of these candles represents a single day. We've been trending very tight in what is now a very well defined range. High being 96.70 area, low being somewhere in the zone of 95.60 ish. And these are support levels for now. I think at some point, if we break higher, but this corresponds to that 114 area in the euro. So just know that if we get lower than this, I think that the dollar is going to completely gap through and zipper down, sort of fill the void that we traded right through in this whole underneath zone that I'm showing. And then on the corresponding euro, it's going to break above this area. So right on this 114, almost perfectly, the century is where I'd be targeting to crash through on the top, probably move back up to the upper range. You know, a lot have been calling for continued weakness for the dollar for some time, and I've talked a lot about it. But during any type of like serious global unrest, I can't think of a better time other than the Great Depression or the tech wreck in 2000 through 03, that the last 24 months have represented, certainly a unrested period of time. The assets around the world from any sovereign country are going to go to the strongest places, right? So, with all of the quantitative easing and essentially fresh cash being dropped down on the marketplace by central banks all over the developed markets, it has just sent the asset prices of many things higher. At some point, it's just like I often joke, if you remember the musical chairs, right? There's a finite number of chairs, typically a couple more bodies than there are chairs, right? And then when the music turns off, you got to find a chair to sit on, right? It's a great analogy for a drying up of liquidity in the capital markets. The problem is there's maybe two chairs and 10,000 bodies. So it's a little sort of a lopsided, and there's just a lack of liquidity, and then everybody starts fighting over one chair and it goes crazy, right? Then it turns into an episode of Jerry Springer. But um, it's from a risk management standpoint, taking all of that I just mentioned over the last 17 minutes and putting it into an actual plan. The key thing is just to be watching for sudden movements beyond any area of support or resistance I've talked about, right? So looking at the S&P, we've had just an exaggerated bubblicious move off of the lows that we experienced in Q1, essentially the end of Q1 of 20, when this whole pandemic thing broke. We had a massive sell-off, and the sell-off was just exacerbated on fear and lack of liquidity, right? So those, but do keep in mind that one of the problems with the marketplace, at least as far as equities are concerned, and if for a lot of our subscribers that are trading equities, the typical stair step up is almost always an elevator down. And it can happen that quickly. As they call it, risk happens fast with a lack of liquidity or liquidity being drawn out of markets. People aren't willing to be. And plus, many of these markets are so ridiculously over leveraged. It's scary. I mean, the levels of margin reported by many of the brokerages and certainly the NYSE levels are historic highs. So, and it may not seem to the typical retail trader, but if I have an account at Goldman Sachs and I'm the first down hedge fund, and I have 10 million bucks inside the account, I have the ability at Goldman and their clearing firm's discretion, obviously following Federal Reserve and U.S. Treasury margin guidelines, I have the ability in some cases to 10x that portfolio up, right? Stupid, right? From a risk standpoint. But I could certainly own $20 million in securities in that fund with a $10 million of cash, right? And in some cases, they'll let you lever it up a lot more. The retail investor cannot do that. But institutionals granted a significantly higher level of leverage if they wish to utilize it, which we would not. So, but it doesn't mean there's tons of organizations out there that have a ton of leverage on, they're chasing Tesla and, 50 other companies have been rocketing up, in the semiconductor space and a whole bunch of other areas. And, as soon as that bat phone rings, as we joke, essentially they got to start liquidating. So that is my thoughts on the main currencies. Let's take a look at GBP, just so you can see a chart of that. We are coming into a stuffy area as far as congestion potential. May hold off some of this continued rally and then start to trade sideways. Ideally, in a market that's more healthy, we're back up into our previous areas of trading, a zone, if you will. US CAD of note. See this big support point? We're right at it. So surprising on the dollar's weakness, I should say, in relation to the Canadian dollar, much more weak than the actual DXY, which is a aggregate of euro, yen, Canadian, mostly euro, in terms of this price structure. All right, Euro GBP for the question I got last week. That needs a weekly chart view to see. We are the edge of the cliff here. Not a lot to trade this, but I'm pretty sure this is just almost exclusively the strength of the pound versus the euro. I don't want to know what's going to happen down here. Again, that sort of liquidity theme and inflation risk from central banks that is one of our number one risk hashtags, I guess, of the current time, showing itself right here. Certainly showing itself in other currencies as well. So let's take a look at AUD USD, still stuck inside a range. What else? GBP CAD, just a couple to point out. I know I somewhat belabored these points, but I think it's certainly worth repeating. Look at a weekly on this. Puts things a little more in perspective when you look at the weekly. You can see over a long period of time, very defined range. This is a good example of when I trade extreme outs. So I often get asked the question if I'm manually trading currencies and I pick a pair, in this case, maybe it's the pound dollar in this Canadian dollar chart here, what trades would you take that are the most conservative? And the answer quite simply is these trades are the ones that are extreme outs. What do I mean by that? Anything that is coming up to these areas. Now, keep in mind, we're looking at a weekly chart too. So each candle represents a week. But every time we've gotten to this 167-ish zone, it's been a buy. Whereas the opposite, we haven't seen that recently, but every time we've gotten up to this top area, one spot 77 uh, area, this whole zone. Remember, it's not a specific price. It's just typically a zone you want to talk about. It's been a sell. So stuff's effective if you use it right. All right, what else do I want to address? Let's take a quick look at crypto before I forget. This is the weekly chart of Bitcoin. Just give you a quick view from the full size, and then we'll switch over to actually, let me just jump out of this. It says a new feature where you can jump back out and make it full screen real quick with a couple of clicks. Pretty slick. But I'm going to go back to daily. All right, so we had the big sell-off, and then we had the rally, obviously, into the damn near 70,000 high of Bitcoin. That capped off what appeared to be sort of a sloppy head and shoulders. My concern was anybody going long up here, I wouldn't have done it. The caution, mostly from my perspective at least, was that it was looking quite toppy, and don't touch it until it starts basing and bottoming out. Notice that we've never seen since that point, at least as far as the daily chart's concerned, a decent pattern that would propose, at least from a midterm or a shorter term perspective, getting long this until it settles out. Right, we had a flash down here. Many bought this, probably caught some decent return. But oftentimes when you have a flash, let's see if I can expand this out to show you guys. When you have a flash candle and you have a huge lift off that, if it's not followed by a whole bunch of follow through days, and see very quickly we had a bunch of dojis, which are indecision days, you can almost bet your lucky stars we're going to go back down and visit the bottom. I've seen it happen time and time again, and sure enough, boom, we went down and hit it, formed a little bit of a support, would not have used this as a place to buy, right? Ultimately, I think that if we do have a drying up of liquidity, the first area it's going to hit is the most aggressive of all assets, and that's crazy small crypto coins and NFTs. They're all just going to get crushed because the liquidity is going to evaporate in those markets. Would not want to be in any of that stuff. A lot of pain probably to come if, in fact, we even get partially correct to what I'm talking about. But in the case of Bitcoin, and we've got a whole new crypto, some fun stuff coming in crypto to our subscribers. So I think this will continue to manifest itself in, at least from an analysis standpoint, the need to look at these charts and understand how these work, right? So I basically had a lot of people saying, "Hey, should I buy here?" And I'm saying, I don't see it. I don't see a chart pattern planning out. And we're right here at the edge of the cliff. Why? Because we had a quick move from 20 to 30. And we had, just an absolute breakout right here. You can see it this is way back in into the third quarter, and then just had an absolute lift off into the third quarter. Is that right? Yeah. More like the end of the third and into the beginning of the fourth quarter, we had a complete lift off. But every time you have a pullback, so you couldn't get there, and then we had a whole bit of just absolute insanity hit in the form of news and different conversations with some personalities, I guess, that pushed the price of this up. And now recently, the traffic in terms of fin or any type of social media posting on crypto is way, way down in its price. So what does that mean for currently what's going on? As a lot of it has to do with just a drying up of liquidity, so our theme stays the same. Anyway, I don't know, just based upon what I'm seeing, I would expect this to probably hit somewhere in the area of 20. That's where I'd want to see a decent basing pattern, something like what you're seeing here, which was a broad cup with handle that sold off into that area. All right, so that's it for crypto. What else do I want to address? Take a quick look at gold spot price. Still tight range. Been in this range for a long time. The argument really is that you'd think, especially in this area when we were starting to break out, was, well, hey, things are getting, sort of disrupted. Why isn't gold rallying more? When realistically, based on where we currently are, um, we should probably be up around 2,000 an ounce, right? But we've just been dragging around the doldrums down here for a long period of time. I think as we begin to see liquidity dry up, depending on how levered global markets are, we could see a rally in this, in which case it'd be worth chasing a potential breakout from a pretty decent long pattern. But right now, every time we rally significantly in this, there are sellers up there. So at least as far as the past, there's been a lot of other time frame sellers up there waiting to sell when we gotten up to that area. Oil, supply chain issues, inflation. You'd probably like, why is the price of oil so high if like not a lot of people are driving as much anymore or going to the office, right? Well, it's been some issues there. And as far as currencies of note, obviously here is the weakness of the New Zealand dollar because of the rally in the pound. It's been a great long trade since the middle of November. But if you look at the weekly chart, I know we try not to encourage the trading of the widowmaker here. I do think of note, we have not been up at these levels since a year and a quarter ago. So we absolutely could just zipper up into this zone. That would require, obviously, I think, more continued strength by the pound. But you can see some of these flash movements, and obviously this one was all pandemic related, but it can happen. So just be careful if you're trading this. I'm just not really a fan of being short at this particular point, unless we saw some sort of flash up, some extreme out move. One of the few times it's sort of, at least a smaller size, to step in front of the train, because you've had some just like a significantly flashy or volatile type of move. Let's see what else. If we jump back to equity land, this is the daily on the stock 600 index. I don't show this as much, but we'll get into it more. Hasn't made a new high. Arguably, this could be a double top. May fade down into strength, or fade down into sort of the edge of the cliff, which is right in this area. So it sort of corresponds with 4,500 in the S&P as well. VIX, call this the complacency index. So when we're up here, it's bananas-ness. You want to be really careful on that. But right now we're hanging out in the doldrums again. I'll just use some sailing terms. We're not up riding the crest up here. We're hanging out in the doldrums. I think that's pretty much it. All right, so hopefully this broadcast went off without a hitch as we stream with professional software. And we'll get the Telegram rooms opened up. Hopefully everybody can post lots of good questions and get everybody educated and make sure all subscribers watch these presentations, which is my goal. So everybody have a great week. May the trades be with you.